Okay, so we're going to react to Tom Lee and what Tom Lee has to say about the V-shaped recovery and actually what that means for you guys and where you should be putting your money as we get through this crazy market that's skyrocketing. Let's see what Tom Lee has to say.
Tom Lee, also a CNBC contributor, joins me here. Tom, good to see you.
Great to see you.
So we have this rally that's now extending probably beyond what most were positioned for, but it started in a moment of peak uncertainty.
When he says peak uncertainty and what most were positioned for, that's where we've got to be thinking through, stay in the market long term.
Yeah.
And even when we were in peak uncertainty, a lot of us were saying that's kind of usually forward-looking bullish. But are we now getting to a point where we have finally feasted on all of the uncertainty and now we have a lot of these blanks being filled in?
I don't. I think that it is appropriate that we are making new highs because the fundamental and the visibility is better now than it was in February at the old highs. And I think there's three levers that are going to get pulled. One we know is that the Fed didn't unleash liquidity at the April lows. So we have a Fed that's been on hold and tight.
Okay, so the first talk there, is the uncertainty gone? I think that's the one thing. By the way, look at Tom's hair. Look, just nice to see you too. So as that bullish individual that he is the uncertainty entirely gone? Well, no, it's not. It's not entirely gone. In fact, it's barely even scratching the surface. And I think if we look at everything from where we've been, the market had plummeted just in April. We're only in July. Okay, so really we're 2 months out from like serious issues. Now, as he's pointed out, like the Fed went through all of April, May, didn't do anything, which is, I think, productive because we've made this rebound. And they haven't really done anything with pulling one of the levers. And there's those three levers, as he mentions, and that's that's the actual first lever. So I think that's something that we've all got to keep in mind.
Information and the data comes in dovish. That's 12 to 24 months of Fed liquidity and dovishness. That hasn't happened yet. The second is that I think that there is a false argument. People are saying the multiples are stretched. The PE should be expanding because we've now had 5 stress tests that companies survived. They survived COVID, they survived the bullwhip effect, they survived the inflation surge, they survived the Fed fastest hikes, and now they survived Armageddon. If you don't have 5 more episodes, multiples will be higher 2 years from now. And the third is that I agree with anybody who says that, look, we've kind of reshaped some of the economic flows around tariffs, but that's an upside story because if it plays out better, that's an earnings surprise. So you have 3 levers that tell us that 6,200 is the market beginning to recognize we're in a better position, while $7 trillion cash is on the sidelines. And I can tell you, our clients, institutional clients, remain very skeptical.
Okay, so then we're looking at what he's referring to. First of all, those 3 levers is that there's a lot of clarity now as far as tariffs are concerned, and as far as the sort of like not really, there's no real negative impact from the tariff discussion currently. So that's something that's of positive. And then we're looking at 10 to 24 months of financial easing from the Fed. And then also just looking through, he's saying $7 trillion on the sideline that still needs to come in, right? And it needs to be factored in. And the big factor as well is a lot of the companies that he loves have gone through COVID, the bullwhip effect, raising the rates super fast that they had to, and then all of everything that's happened over the last year and a half, and we are looking at a lot of successful companies here. So there's sort of 5 different things that he's talking through, those 5 key points, and if that doesn't happen over the next 2 years, we're going to be in a really good spot 2 years from now, right? So I think that that's like a real important thing to think through, is that when we're talking about these based off of what he's talking through, it's like there's those 3 levers. Those are going to be productive. And then there's those 5 things. So let's see what else he's got to say.
200 is the market beginning to recognize we're in a better position, while $7 trillion cash is on the sidelines. And I can tell you, our clients, institutional clients, remain very skeptical. This is the most hated V-shaped rally.
I grant that given the strength of the rally, investor sentiment pretty much across the board has lagged. It's not as bullish as you would normally expect. The $7 trillion in money market funds, though, I mean, to me, it's a non sequitur. It always goes up. Unless you, at the end of an awful bear market, the money doesn't come out of money market funds. And then right now, as a percentage of total market cap, the S&P is like $60 trillion, or the U.S. market is. It's like, what are we talking about?
Well, there's a couple things to keep in mind. One, in fact, money market balances have declined. They only started to rise really in 2022.
Right, they had a stutter step and then they went up.
If you look at margin debt, NYSE margin debt, the dollar amount absolute is still below where it was in October 2021. So you have like 4 years, it's 4 years and you're still not even higher in margin debt. And third, it really doesn't take, you don't need 60 trillion to come into the stock market to have it rise 10%. You probably need 200 billion. And I think there's a lot of high net worth money. I know there's a lot of our institutional long short macro that is shorting this rally. And the long only managers are defensively positioned. They don't believe in a cyclical long. But look, if rates come down and the Fed starts easing.
Okay, so that's pretty crazy. He goes in even further. That $7 trillion, a lot of these institutions are still very tentative to get in. And a lot of high net worth people also are tentative to get in. And so I think that's an important point to take home, especially we know normal people, us, who are trying to get in the market. We can make the most gains before something starts to pop off, right? So you look at Nike. Okay, we could get, if we would have gotten into it, a couple months ago, be a $50 buy. Now it's at 70. Where's that going to go? They're making it same thing. Adobe's down right now. Okay, that's another thing. That's another company that we can get into. So think through those things. I'm not saying to get in there, but like think through stuff. AMD is the big one, right? So you're looking at this and you're hearing what he's saying. You're like, okay, this is making sense. So let's see what else he's got to say.
Jobs number today and how it bears on all of those factors, whether it's timing of the Fed, whether it's the underlying resilience of the private sector, which maybe is still kind of in watch and see mode. How does that bear out?
Well, today would have been a day where if it was weak, then the Fed has to change its calculus. But the job market's good. So now the waiting game is how much will inflation surge over the summer? Inflation expectations are actually coming down. So now all that we're waiting for is let it get through this CPI hump. I do think it means that once you get into September, we should really think about cuts coming. And that's what I would focus on more as an investor, that's a cutting cycle. The Fed won't just do one cut. They're going to continue cutting. ECB and the U.S.
Okay, so he's talking about the jobs market and you're looking at the numbers and he's going, well, these numbers aren't bad. They're pretty freaking solid. Actually, like not great, but we're in a pretty good spot. So that's not a huge concern. The next thing that we got to think through is inflation. What's going to happen with inflation over the summer? Get through the CPI hump. Now, he's basically saying there's going to have to be some type of rate cuts by September. And when that happens, he sort of circles back to now we're looking at a cycle of cuts. It's not one, it's not just September. There's another one that's going to come in early or late 25, right? So if it's September, a lot of people keep thinking Halloween might be scary, literally, like not from scaring people, but actually like there might be something that we might see some drop off in the market into the end of 25, similar to what I've talked about with relating it back to 2018, where we might see a drop off at the end of 25, but then another rate cut could come. So we're seeing an actual cycle, and that's sort of what Tom's referring to. So let's see the rest of this dreaded V-shaped recovery.
Cuts coming, and that's what I would focus on more as an investor, that's a cutting cycle. The Fed won't just do one cut. They're going to continue cutting. ECB and the U.S., 200 basis point different in monetary policy rates, but if you take CPI year over year ex housing, which is how Europe calculates it, we're both at 1.9%.
And what does that mean for us as normal people, right? So I think one, just always make sure that the risks aren't crazy, right? That's the first thing. Second thing, dot the financial I's, cross the financial T's. As I say, Trumpsky's a little volatile. So we know that the end of the year, there might be some craziness, right? So we've got to be ready for that and just emotionally look at that. The third thing that I want to talk about is look for the sentiment that is low. So companies that have low sentiment, and also be aware of companies like AMD that everybody's starting to get into. There's that $7 trillion. There's some Fed cuts coming. So we've got to prep and say, hey, if we've got our emergency fund set up, okay, and if we're making more money than we spend, we need to, one, be setting up that position right now. Two, we need to be prepared emotionally, like I mentioned. And then three, deploy it week over week and think through where you want to put it. Make sure that you've got, I look at like a value aspect is like, my value aspect is all the ETFs. I put it in VU, I put it into SCHD. You put it, I look at the three portfolio more so as like ETFs and then dividend stocks and growth stocks. That's my three portfolio, my three levels of portfolio, the three folder portfolio, the way I look at it. Sorry, a terrible explanation, but the way I'm thinking through that, that's how I think we should be planning. And in the meantime, you gotta work a lot. You gotta make money. You gotta make sure you're not buying dumb shit. And you've got to be able to control everything and move things around and have 12 months of that emergency fund set up. And also make sure that you have that into a decent freaking, some type of high interest, a high yield savings account, so that you're not just blasting through that, or you're not having that sit in a bank account and not doing anything. So make sure all of those things are checked off. Tom Lee's a bullish type guy. I like listening to him. You can learn a lot from listening to him. A couple of people had asked me to react to what he had to say and what are my thoughts around that. I hope that helps somebody out there. Until next time, peace.